there's a saying that you can sit in the shade of a tree today because someone planted the tree 20 years ago.
Yeah, that's exactly right. Dividends, reinvesting the dividends. I mean, kind of a no-brainer.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are back on the 360 Money Matters podcast.
Andrew, we absolutely love it, my friend. And what are we talking to everybody about today?
Today, we are going to talk about your main man, Warren Buffett, and we're going to talk about the seventh wonder of the world. What is it, Bills?
It's compounding. It is compounding. And he's 96, 92, something like that. I'm getting him confused with Charlie Munger, but that's the story of his life, right? It just, like a fine wine, it just keeps getting better and better and better with age.
Yeah. I absolutely cannot remember the numbers, and so I'm going to completely butcher this. But it was something like it was either 95 or 99% of Warren Buffett's current wealth was accumulated after his 60th birthday.
Yeah.
It just shows that if you're in the market for long enough, and if you just basically stick the course for long enough, the benefit the compound interest can have, particularly when you're at, what is seemingly your peak asset level.
Andrew, and look, I guess it's important to point out as well too, we're not necessarily just talking about investment markets, stock market, shares. This could be anything. I mean, we're referring specifically to, when we talk about compounding, essentially in its really simplistic term, it's earning a rate of return on a rate of return on a rate of return, and doing that each and every year. And when you graph that out, and when you look at it on a table, the amount of money that you earn over a longer period of time, if you look at the capital that you've invested into something versus how much you've earned from the return, that grows each and every year as it grows on top of itself, and it becomes phenomenally powerful. Using that example that you had with Warren Buffett, our main man, it's amazing where those numbers get to, and it's almost unbelievable to talk about. It's actually one of those things that you encourage everybody to say, hey, go and find a compounding calculator online and just play around with some inputs and see what that does. We've got some examples that we're going to talk about a little bit later on in terms of what that looks like, with some specific numbers and some specific dollars and stuff like that. But it's really something that we encourage everybody to go and have a play around with, because the results are just absolutely phenomenal. And can't take it back, but I wish going back to maths in school, I swear if that was the only thing that I learnt in maths, it would have been well worth it, rather than all this other stuff that I really can't remember.
Yeah, I just feel like as humans, like we're not wired to understand and conceptualize compounding, because I feel like there's just so many. It's too simple. It's not even too simple. Like, I mean, if you ask someone, what is, 8 plus 8 plus 8 plus 8 plus 8, then pretty easy number to figure out. But then you start saying 8 times 8 times 8 times 8 times 8 times 8. It's like how much of a difference that makes in the end figure is just phenomenal. And, if maybe going back to basics for some that, might have heard of this term but not fully understood. I mean, the impact of compounding interest is that you invest $100 today, and that $100 today, let's say, earned a rate of return of 8%, and then next year you've now got $108, and you invest $108, and now all of a sudden you're not just earning interest on $100 that you had originally invested, you're earning it on $108. So that $8 is earning another 8%. And then the next year it's doing the same thing and the same thing. And what starts with a relatively small amount of money when you initially kick off the compounding, it's almost like a snowball going down a mountain. And at the start, it's just the little snowball, and then it's accumulating snow and accumulating snow and accumulating snow. And by the time you get to the end of the mountain, it's this big giant heap. Or, planting a tree today, and okay, you're not going to see, maybe any fruits from that tree, but then all of a sudden, you plant one tree and it grows fruits and it drops fruits, and then, more trees are coming up next year and they're dropping fruits, and it's not just the one tree that was originally dropping fruits, it's the one after, and all of a sudden you've got a forest at the end of it. So compounding interest is the same thing, but with money. You're talking about earning interest on interest on interest on interest, and that snowballing into what is effectively a much larger and much more significant amount of money.
What type of tree?
We're Greek, Billy. It's an olive tree, of course. We don't even need to talk about it.
Andrew, what I'm going to do, I'm going to explain the same sort of concepts, but we're going to use some numbers here. So hopefully everybody doesn't get lost. So I'll do my best to try and explain this. But we're comparing two people. Essentially, you've got, we'll call her Sarah. She's a 25-year-old and she's investing $10,000 a year. We have used a rate of return of 8%. So we've made an assumption that she's investing 10 grand a year from age 25 to age 35. Yep. So she's gone and invested over that decade. She's gone and invested, in this example, $100,000. Then we have the other investor called Mark, and he's delayed the first 10 years of investing. So he's not starting at 25 like Sarah is. He's starting at 35.
Yep.
We're using a to age 65 time frame. So Mark, the second investor, continues investing from age 35 for 30 years, all the way up to 65. Sarah only invested for 10 years in terms of contributions, but she holds her investment. So if you look at this, Sarah has invested $100,000, but she started 10 years earlier than Mark. Mark has invested $300,000. I've got a lot of numbers on this page here, Andrew. So we're talking about 3 times more than what Sarah has. But when we look at the value of the portfolio using an 8% compounded rate of return, Sarah ends up with $1.45 million, even though she's invested a third of what Mark has. Mark ends up with $1.13 million over that same period of time, even though he's invested 3 times more money than she has.
Now, this physically does not make sense to me. And I work in finance and look at these numbers all of the time. But I think back to someone who, and you use that as a practical example because I'm not that far off the age of 35. And you think, if I had invested $10,000 a year, just perfectly doable, that's it. Like I'm better off having done that and stop now versus trying to do that every year for 30 years until the age of 65. I mean, you're talking about even when you're looking at this, Mark in this scenario is not starting that late. I mean, you're talking about investing at the age of 35. We're not talking about investing at the age of 55. And he's continued all the way up until retirement at age 65 versus having a slightly earlier time period and then stopped your investment and just left it in the market. And the difference is phenomenal. I mean, you're talking about having invested a third of the money and having $300,000 more.
Yeah.
One takeaway that I take out of this is, holy crap, that is insane how much of a difference it makes to start earlier. The other takeaway that you should be taking out of this is just start. I mean, it doesn't matter whether it's $10,000 a year or $5,000 a year or $1,000 a year. The amount of money is irrelevant in the grand scheme of things. What is far more important is just getting in earlier and doing that at an earlier period of time. I also go to, and we'll talk about, small contributions on a regular basis, but I also go to the psychology of money when you're starting to talk about this as well. In that, let's assume Mark in this scenario, for the first 10 years says, what am I, and this is a really common occurrence when you're talking to clients from a financial advice standpoint. $10,000, I invest that for 10 years. Oh, sorry, $10,000. What's the point of even investing it? Mm-hmm. I make an 8% rate of return. I'm just going to leave it in a savings account. I'm going to get 5% in the savings account. There's a difference of $300. What's the point of investing? And what I come back to is what most people end up doing. What most people end up doing is, let's assume that you have the discipline, right? Let's assume that you put that money away and you put it into a savings account and you don't invest it until it's a significant amount of money. What are the decisions that you're very likely to make if you fast forward 10 years? The person who invests $10,000 a year and compounds and grows their wealth and now has, I'm not even going to assume a rate of return, $100,000, and they've been in the market, they've invested, they understood how it works, they've built a portfolio, they know, what they're comfortable with, what they're not comfortable with, their risk tolerance. Or the person who's done nothing until it's a significant amount of money, has $100,000 in a bank account, they've worked hard for the last 10 years to save that up. What percentage likelihood would you place that person would rip all of their savings out and put it into investments?
Yeah.
I can tell you from experience, it's pretty close to zero.
Yeah.
Most people, if you've not been invested and you've not done it consistently and you haven't gotten used to the concept and you don't understand how it works and you don't have experience with it, deciding to delay until you have a more significant amount of money, once you've built that up, you're less likely to invest it because there's a really big risk aversion to, hey, this has taken me 10 years to build up. What happens if I lose it? What happens if it doesn't perform? It's the psychology behind, it doesn't matter that the returns are going to be lower in the beginning. That's not what you're doing it for. You're building a base. Yes, there's going to be compound interest. Yes, the earlier that you get into it, the more beneficial that it is. But you're building a base, you're building an understanding, and you're allowing that to form a platform to be able to make bigger decisions in the future when the time comes.
Yeah, no, well said, Andrew. And I think to sum this up nicely, I mean, it's not about how much you invest, it's how long you're investing for. Yeah. I want to use another example of, say, property, but we'll talk about a rule of thumb that we use in the industry, the rule of 72. So what this is you divide 72 by your annual rate of return to figure out how long it would take for your investment to double. And what I want to do is use this example using, say, property, right? So let's use 7.5% rate of return. Approximately that will double your money, or 7.2%, that'll double your money in 10 years' time, right? If you're doubling your money every decade, let's assume that you buy a house for $500,000, right? And the reason why I use a house, and I've changed it from what you're doing, is because it naturally just changes your mindset around the amount of money, the actual quantum. So $500,000 in 10 years' time goes to $1 million. So the first decade, it doubles in value. Second decade, it goes from $1 million, doubles again over 10 years, to $2 million. So that's 20 years. $500,000 now goes to $2 million in 20 years. And then the third decade, to 30 years, it goes from $2 million to $4 million. So all of a sudden, over a 3-decade time frame, assuming that it doubles in value every 10 years, you've gone from an asset that you've purchased for $500,000 to, I've lost track of my numbers, $4 million. So you've made, taxes and bits and pieces, holding costs and stuff aside, 3.5 mil. That's just with, and we're not using outlandish rates of return or anything. This is the significance of it. The only thing that I've done differently to our original example is I've just used a larger starting number and I've assigned it to something like property because it's easier to imagine because I guess it's tangible.
Yeah.
Phenomenal how compounding interest can work over time. Now apply that same methodology to any asset class and you start to get the idea of what we're talking about.
Yeah, exactly right. And I think that what you will start seeing is, and the beauty of this is you've already started to see a portion of this in superannuation. And that's why, I mean, pandemic and all of that stuff aside, but when you were talking about that time period of being able to access $10,000 from your superannuation because of, or it was something that the government had allowed, financial advisors were screaming. You're like, what are you doing? You're interrupting compound interest. And that is quite literally the worst thing that you can be doing in this strategy. You go back to your example and maybe it's not invested in property, maybe it's invested in something that's more tangible like managed funds or shares. All of a sudden, people now have the ability, and there's the temptation of, 500,000, it's worth $1 million. I can pull 100,000 out.
Yeah.
That's not going to make a huge amount of difference. And you start to interrupt compound interest, and all of a sudden you're not earning interest on interest on interest on interest. You're taking a step back, and that time period to be able to make that up, it increases exponentially versus having left that money in the market and allowing compound interest to do its thing. So the key takeaway is, one, have the discipline to do it. Have the discipline to start. Even if it's small, even if it's something that seems like it's insignificant, the impact that it's going to make is ridiculous. But then having the discipline that, okay, I've gotten started, I'm halfway down the path, or I'm, a tenth of the way down the path, continue the course. Maybe your assets are going to shift, and maybe where you invested at the very beginning is not the right investment to be in moving forward. And so you need to make an investment change. But selling and liquidating and interrupting the compound interest, that's the worst thing that you could be doing. And have the emotional discipline to stick with it is just as important as making smart financial decisions.
Yeah, and Andrew, as you were sort of describing that, I was thinking about an analogy that we could use, right? Because using that example about investing $10,000 in year one and going, okay, 8% return, great. That's using those numbers. That's what you need, right? If you turn around and say, I've invested, 10 grand, I've only got an 8% rate of return. It's $800, big deal, right? If you then change the analogy and go, hey, and looking at that example and going, what am I going to do with that? It's insignificant. So I'm not going to waste my time, or I'm going to pivot, or I'm going to change. Change that analogy and go, okay, we're planting a tree because we're going to grow it, because in the future we're going to need shade, right? For whatever reason, old, grey, I'm going to need somewhere to relax. You look at the tree, and in year one, it's grown by, you see some little grass roots coming out. Year two, you see a little bit more. You don't change your mind and go, well, hang on a sec, it's only grown by a couple of inches. I'm going to take it out of the ground. I'm going to interrupt the growth process just because I can't see it growing. But if you leave it, you water it, you nurture it a little bit, you keep an eye on it, but you don't touch it, it's going to grow into that tree that's going to provide that shade. I think that's a really good analogy, because if you were doing it from a gardening perspective and you planted something, you're not going to interrupt it, because you know that you're not going to get the tree that you need for decades and decades and decades down the track. So why do we apply a different thought process and methodology when it comes to investing? I'm not sure. Anyway, just thought that would be
it's an interesting thought process, because it's absolutely true. The only certainty, if you do interrupt that process, is that you're not going to get to it. And so maybe, you're tweaking around the edges to make sure that you're getting the most out of it. And maybe you're, altering the investments if there's a requirement to do so, but you're still remaining invested.
There's a saying that you can sit in the shade of a tree today because someone planted the tree 20 years ago.
Yeah, exactly right. Dividends, reinvesting the dividends. I mean, kind of a no-brainer from our end of things, but really a big thing that we think is, one of the most important aspects to this is making sure that if you are getting dividends on those investments, it can be tempting to say, I want to pull something out and I want to make sure that, I'm getting something for how much I've gotten invested. But, dividend reinvestment plans, if it's available in the shares, or maybe if it's, on a platform, then the dividends goes back into the cash account and gets redistributed, but making sure that your dividends are naturally getting reinvested, as opposed to I receive the dividends and I'll buy more shares, but that's just further down the line. Automate as much of this process as possible. if you can take the think work out of it, direct debits, that's your best friend. It's your worst friend when you're looking at subscription services, but it's your best friend when you're looking at investing. If you can direct debit and take the think work out of investing, then exactly the same thing when it comes to dividend reinvestments. Dividend comes in, it automatically gets reinvested. I don't have to make a decision. It just happens, and the thought process is out of my hands and out of mind. And I'm making good financial decisions just purely by not doing anything.
Yeah, and I guess that's that's a perfect example of why superannuation does so well as a compounding vehicle, is because you've got the rules of preservation that sit around it. So you can't touch it, withdraw it, interrupt it. You've got mandatory super guarantee contributions that if you're an employee, your employer has to pay contributions all of the time. Contribute money, throw money into it, allow it to reinvest within itself and don't touch it. And then in 3 or 4 decades, you've got this nest egg essentially where you can provide, retirement income for yourself. So it's, we're seeing it with superannuation. It's just that the rules around it, prevent us from putting our hand into the jar to interrupt that process. Andrew, they say it, start now. The best time to plant a tree is today. Next best time is tomorrow, or yesterday and then today.
Best time to plant a tree is yesterday. Second best time is today.
Well, we can't go back on that, but exactly right.
But look, I mean, that is the key takeaway, is even if it seems small, even if it seems insignificant, even if it's, something that you don't think is necessarily worthwhile, the best thing that you can do is start, compound, invest, and the earlier that you do it, the far better off that you're going to be.
Well said. Well said. Well summarized, Andrew. I reckon we did that one justice. And for all of those people that are out there that haven't started and thinking about it, reach out to Andrew and myself if you want to have a chat. Details are in the show notes as always. Andrew, thank you.
Thanks, Bills. Thanks for another great episode. If you got some value out of that one, like, subscribe, share, and we will catch you on the next podcast.
Thanks. Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au. The information in this podcast is general in nature and does not take into account your personal objectives, financial situation, or needs. It is not financial, legal, or tax advice and should not be relied upon as such. You should consider whether the information is appropriate to your circumstances and seek professional advice before acting on any of the information provided. Past performance is not a reliable indicator of future performance. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of Akumin Financial Planning Pty Ltd.